The magic words in real estate, write-offs. That's what you want. Everybody wants as much write-off as you can get every single year because it's the time value of money. You want it now. You don't want to wait 37 years. You want to take your expenses now.
From cornfields to high-rises, office to industrial, houses to hotels, and every other asset class in real estate, we cover the people, the projects, and the profit. Welcome to the Investing in Iowa show. This show is for go-doers, action takers, and business owners. It's for people like you who are sick of Uncle Sam taking a huge bite of your apple. If you're looking to get ahead of what's taking place in Iowa, learn who is doing what, and how you can get in on the action, you're in the right place. Hosted by Neil Timmins, an Iowa native who has been involved in over $300 million in real estate, right here in Iowa. Recording in studio from West Des Moines. Here's your host, Neil Timmins.
I've got Joe Viery here on the show. Joe, welcome.
Hey, Neil. Thanks. Great to see you again. Not see you, but hear you.
Yeah, it's good to see you. Good to see you here on Zoom as we record this, but good to hear you. Say, for the audience's sake, who are you? Where are you from? What do you do?
Okay, my name is Joe Viery. I own a company called U.S. Tax Advisors Group Incorporated. It's been shortened to USTAGI. And bottom line, what we do is we perform cost segregation, which for the investor in real estate means we accelerate their income taxes. And you need an engineering company to do that. I've been doing the cost seg industry since 2007. I've owned my own business since USTAGI since 2017. And there is absolutely very few reasons why somebody would not want to accelerate their depreciation.
Yeah, good. I wanted to have you on. Now for the audience's sake, you don't live in Iowa, but you do come to Iowa. You and I have been friends, I don't know, for 5-6 years now, probably. And you have done all my cost segregations, in fact, in every state where we own anything. And so I get the pleasure of routinely seeing you as we acquire something here in town. You fly my way to say hello and look at the property. So let's talk about a property. When you say you're going to accelerate that tax benefit, what in the world does that mean?
Okay, so basically, the concept is relatively easy to explain, but it's difficult to do it correctly according to the IRS rules and regulations. And basically, all we're doing is the IRS recognizes that your building is, I use the word used up. So let's keep using that term used up. Your building is being used up over time. And so rather than wait to whenever you have an improvement to be done, the IRS is saying, okay, you can actually use a depreciation expense to signify that your building is deteriorating as you own it. And why do people want expenses? Because when you have gross taxable income, you want to reduce your gross taxable income. And one of the ways in real estate, which is magic, is depreciation. You can deduct that expense from your gross taxable income. Voila, I've now either reduced or eliminated your state and federal income tax. So that's basically the overview, the nutshell of what we do. If you do not accelerate it, then you take the easy way, which anybody, probably a 3 or 4-year-old could do this. All they need to do is take the building basis, which is what you pay for a building, less the land, because land is not depreciable. What's left over is your building basis. If it's residential property, you divide by 27 and a half years. If it's commercial, 39 years. So you can see you just get a little bit of the expense every year for the next 27 and a half or 39 years. If you do cost segregation, we're going to accelerate that. So you're going to get a huge increase the year you do the study. So right now, tax year 2023, for all intents and purposes, should be put to bed. I do have people call me that don't file their taxes on time. But let's say that everybody were good boys and girls. That means we're now working with the tax year 2024.
All right, so they're going to accelerate that. Talk to me about, pick any asset in the commercial world, because all assets are not created equal. I suspect that there are different schedules and there's different depreciation benefits for each different asset type. And maybe when you say you got to accelerate that, what types of things are we accelerating inside of a particular property?
I remember one of the buildings we did for you, it was a commercial, I think it was a bakery building.
Oh, yeah. My first commercial building that I acquired, which Hy-Vee is my tenant, still a tenant today, and they operate their bakery out of the building.
Hey, Iowa investors. This is Ava Baukamp, Chief of Staff at Legacy Impact Investors. Have you thought about adding real estate to your portfolio but don't have the time or desire to play landlord? At Legacy Impact Investors, we do the heavy lifting. Our team finds the deals, manages the properties, and handles all the day-to-day operations. Our select group of qualified investors co-invest with us, gaining ownership equity without opening a tenant email or responding to a maintenance call. They just share in the income, appreciation, and tax benefits. These opportunities aren't for everyone. They are for qualified, accredited investors only. If you want to learn more, please visit legacyimpactinvestors.com to apply.
Yeah, so that's a good one. So for example, what are we looking for? We're looking for personal property, which is 5 and 7 year property inside the building. And we're looking for the land improvements, which is 15-year property. The building, a commercial building, will always have 39-year property because that's the main core of the building. That's the walls, the windows, the roof, the HVAC, the foundation. All of that has to stay. So what we're looking for are all of the items we can peel away and put in shorter lives. So in the interior of that building, we found items like refrigeration, huge refrigeration in that building. We found things like specialty lighting. Every building's got main lighting, but there's always, with industrial equipment, there's specialty lighting, a spotlight to go down on one piece of equipment rather than illuminating the whole room. So we're looking for specialty lighting. We're looking for specialty electrical, hooking up all of those machines. That's all 5-year property. Even though it's a wire, if it goes to a piece of equipment, now that's 5 years. So what we do as engineers, we have to identify, okay, you've got a conveyor belt. Okay, the conveyor belt has to have specialty power, and we have to determine what part of the wiring belongs now in that shorter life asset. On the outside of the building, we're looking at 15-year land improvements. Very simple. Fencing, asphalt, landscaping, irrigation, all of those fall into the 15-year. And again, you're always going to have 39-year of the main structure of the building.
Yep.
So what we do as engineers is we have to piece out, take out of the building basis all of these different items that go into 5, 7, and 15-year.
All right. So you pull them apart, and then what happens? How does that stuff get moved forward? And what does that, maybe put, give me an example, or it doesn't even have to be a real example. Put some numbers to this so we have a concept of what kind of financial benefit it might look like for somebody.
So normally, like in the building we did the bakery, I am not really 100% sure. I don't have it in front of me, but I would guess we found out of the building basis, and let's just use round numbers, easy numbers. These are not your numbers anywhere near. I don't remember what your building basis was, but let's say you bought that building, Neil, for $1.2 billion, and you told me, Joe, $200,000 is going to be the land. Now I've got $1 million to work with. So what I mean is you can take that $1 million and divide by 39 years and get that little small number every year for the next 39 years. Or I can go in there and break all of the short life assets out. And when I break them out for that building, I probably found this example 30%, which means I broke out $300,000 as an additional above and beyond your normal depreciation. The $300,000 is what you would have received on the $1 million building for tax year 2023 if we did it for 23.
Yep.
So $300,000. If you're at a 40% tax bracket, and who knows what your tax bracket is, 40% is $120,000 I just allowed you to keep in your bank. And then I hopefully want you to go out and buy more property like Neil does, or fix your properties up and improve them. But basically, that's real cash. That means you not need to write the check to the IRS. You kept that $120,000 in your bank account. That's the power of Cost Seg.
It's absolutely incredible. Now, love him or hate him, I think we should be able to all agree, I hope, Donald Trump has a fair bit of money behind him, and he probably made a fair bit of money in real estate. So if we can agree on those two things, what he said next may be something worth listening to. He said, if you're in real estate and you pay tax, you're doing it wrong. And it's largely because of the depreciation, the ability to do exactly what you're talking about, Joe. And he certainly edited, they had the Trump tax cuts, which gave us some significant bonus depreciation when he was in office last time. We'll see if those get extended, modified, or maybe expanded as he goes back as we roll into 2025. So more to come on that. Do you notice a difference between asset classes? So industrial to apartments to call it a medical office. There's probably some variance, but maybe I'll throw the next one in there, which I know there's some variance in, a gas station.
Yeah. Oh, yeah. There are winners and losers in depreciation. I'll give you an example. If you have a warehouse that has 4 walls and a roof, a lot of people think that, oh, what could you find in a warehouse? It's an empty building. But yeah, there's a lot that I can find in the warehouse. Primarily, a lot of it's going to be 15-year outside because every warehouse has asphalt. They have fencing. They have curb stops. They have landscaping, irrigation, blah, blah, blah. But bottom line is any type of building we can find value. And so it's really important for the investor to know that the richer the buildings would be the ones that have more interior personal property. So let's go through a couple. Hotels, huge. Senior centers, huge. Medical buildings, huge. They've got all of these medical equipment. We mentioned medical equipment in your example. The bakery was a rich opportunity. Yep. So warehouses would be on the low end. On the high end would be buildings that have a lot of building material. You're building out and you have cabinets, countertops, and that type of thing. But don't be disappointed because I could really find value in really any type of building.
Yep.
Multifamily residential used to be stronger, but it's still very valuable. The reason why it changed a couple of years ago is the IRS is no longer allowing us to take cabinets and countertops in the inside of residential, which is weird because we can take them in commercial. So if anybody wants to know why Congress is so screwed up, it's okay. The cabinet's a cabinet. I can take it, accelerate it in commercial, but no, I can't do it in residential. Why? Stupid.
That is unbelievable.
Yeah. So they changed that a couple of years ago. So we're no longer allowed to take those items, but I can still find value. It's just for a multifamily, we would find 30% accelerated and now it dropped it down to about 26% on average. So we still find tons of value. It's just that it used to be higher. But again, even single family homes for us, we do a really good job on smaller buildings.
Let's talk about single family homes because I think that's a part that lots of single family investors have never even heard of this, never thought about this. And now as we're talking about this, maybe they're wondering, does this apply to me? So let's talk a little about houses because I suspect the last thing you're doing is getting in a plane, flying across country to go look at a house.
No. And that's why in my first start of my career is that nobody in this industry did single family homes. We couldn't make the numbers work. By the time you did the inspection and got an inspector out there, it was thousands of dollars. And if somebody bought a home I'll make it up, in Alabama for $300,000, the numbers won't work because of the expense of doing the inspection. So what we've done over the years, and I'm not talking about 2 years, I'm talking about over 7 years, is we've developed an analytical approach where we no longer need to fly out to the building. We only do this for smaller buildings, and the line drawn in the sand is $1 million building basis. So if you have any type of building for $1 million or less, we can do the modeling study or analytical study, and we can do it for well under $1,000. So we make it work. We give the single family home or duplex, a quad investor, residential investor. Now we give them a great opportunity because in the past, maybe even today, their accountants don't know that there's somebody that can do the modeling technique, the analytical technique, because there's so few of us to do it across the country. The most accountants and most owners of property don't even know that we can do an analytical process.
All right. So let's say, for an example, I'm a single family investor. I own a number of rental properties. I've owned them for a period of years. Is there a way to help me now? Because I didn't buy it this year.
If you're a house flipper, execute the burst strategy or do double closings and are in need of money, Little Guy Loans is your go-to lender here in the Des Moines area. Time is money. Loan approvals in 24 hours. Closings in 5 days. Little Guy Loans was founded by Neil Timmins, an investor just like you. Since he has been in over 10,000 homes in Des Moines, there's never an appraisal. Houses, multifamily, and commercial property loans up to $1 million. Check out www.littleguyloans.com.
Yeah, actually, that's an excellent question because in all the years I've been doing this, I've got all these 22 items of misconceptions, and that still is a misconception. What happened when the Hospital Corporation of America sued the IRS and won is basically the judge said, look, IRS, you should have been telling the taxpayer that this is the way you wanted them to depreciate a building, and you didn't tell them for years and years. So now what we're going to do is we're allowing the taxpayer to go back in time and to accelerate their depreciation and get the benefit. So what we do is we put a very soft line in the sand about 15 years prior to when you bought the building. So we're looking at the acquisition date. In cost segregation and depreciation, the value of the building currently is not part of the function. We don't care what the building is worth. The IRS only cares what you paid for the building. So I can go back in time, let's say 10 years, for example. I can go back in time and I will do the calculations. Okay, this is how much depreciation you took straight line in those 10 years. Here's your new depreciation, the accelerated depreciation, and here's my fee. And if I can come out 10 times my fee, then it's going to be worth it to do the cost seg. So if I charge you $675 to do this study, I want you to save at least $6,000, $7,000 in income tax. So bottom line is we do not need to go to the building. We can do this by sitting in the comfort of our own offices, and we can do this to make the value proposition outstanding even for the owners of small single-family homes.
All right. Does that mean I've got to go back in time and amend a tax return, or does it somehow apply to today's world?
Oh, I love you. No, that's another one. Amendments of bad return. We do not do amendments in cost seg. We have that special provision where the judge said, IRS, you must allow them to change their depreciation schedule, their tax return, because they did not do cost seg. So we have a get out of jail free card that you can use. And basically it's called a 3115 or a change of accounting method form. So you do have to file that form with your taxes, but that then tells the IRS that you're going back in time. You're going to recuperate all the losses that you didn't take when you should have taken them. And bottom line is, here's the math, because there is math involved. We do the math for the accountant and for the client. USTAGI does the math, but we don't file tax returns. So then they're going to have to get an accountant that's going to file the tax return and the change of accounting method form. But we do the heavy lifting. We do the math.
Okay, you're doing this cost seg. I've got any building. There's a roof on it. The roof eventually needs to go out to be replaced. What happens if some of these items, like a roof, for example, it hasn't been fully depreciated off of, there's still some value associated with the roof. It didn't fully come off. The value is not zero. Is there anything that I can do relative to disposing of an item of value when I have to scrape it and put a new one on?
Here's the deal. What we do in cost seg, we're taking the example I gave, the $1 million building basis. In essence, what we're doing, the engineers are breaking that $1 million down into all of the components of the building. Otherwise, you, the taxpayer or the accountant, would have no idea what the roof cost. We break the roof out. So now you do know out of that $1 million, how much of that was the roof. I'll make up a number. Let's say the roof was $59,000. But let's say now you bought the building 2 years ago. Now you got to depreciate. You're going to take the old roof off and put a new roof on. You still have, remember, 39 minus 2. You've owned it for 2 years. You still have 37 years of depreciation on that roof. When you put the new roof on, you need to depreciate that roof again at 39 years. A roof is not a short-lived asset. It's a long-lived asset. So what, in essence, do you have? You have two roofs on the schedule. You have the original one baked in the acquisition. You have the new, because you've got the cost of the new roof. The IRS says, no, you can't be depreciating two roofs. So they make it mandatory you dispose of that old roof. Whatever the remaining basis, I told you, 37 years of leftover basis, that needs to be deducted as an expense. When I say it's mandatory, I say it tongue in cheek, Neil, because really, I don't think the IRS is going to take anybody to court for not doing this, but it is part of the law, meaning that they don't want you depreciating two HVAC systems. They want you to write it off. And I just said the magic words in real estate, write-offs. That's what you want. Everybody wants as much write-off as you can get every single year because it's the time value of money. You want it now. You don't want to wait 37 years. You want to take your expenses now. So one of the advantages, if you work with a company like USTAGI for cost seg, is we give you the roadmap of all the building components. You throw something away, write it off that year. You have to do it the year that you disposed of the asset. You can't wait 2 years or 3 years or 4 years. If you miss that year, then that ship has sailed. Nothing we can do to go back to that write-off. But there again, everybody should understand dispositions can sometimes be a lot more valuable than accelerated depreciation.
Yeah, you're completely right about that.
Yeah.
Joe, highly educational. I love talking to you. I always learn something new every time we get together and connect here. I've asked you tons of questions. What's a question or two I did not ask that we should absolutely cover for the benefit of the investors out there listening?
You know what? I think you covered the main topics. Number one, to know that for smaller buildings, there is a methodology out there that's IRS compliant and that they can do for smaller buildings. That's number one. And I beat the drum always on dispositions because so few accountants and taxpayers, they don't get that they need to write off those assets that they throw away. I think we covered it. And then the number three is the fact that accelerated depreciation, you can go back in time and do it. If you missed the boat and you bought the property 15 years ago, I might be able to salvage a lot of depreciation expense. I would get a no-cost estimate from USTAGI. We don't charge for it. We need some basic information on the building and see if it makes sense. If you and your team says yes, move forward. If you and your team say no, we don't think it's going to work for us. Very few times does Cost Seg not work. Let me just bottom line. Sometimes it doesn't work, but it's so few that I could talk about them, but it's very few circumstances where extra depreciation I would not advise. One of them, by the way, is, I'll tell you really quickly, are flippers. You need to hold the property for at least 2 years. If you're a flipper and you're not going to hold you don't believe you're going to hold the property for at least 2 years, don't do Cost Seg because it's the time value of money. And if you're only going to keep that extra cash flow for 1.5 to 2 years, it's not going to pencil out to go through the pain, meaning paying me a fee and getting my information. It's probably not going to be worth it to do Cost Seg. So that's another case. Flippers, don't call Joe.
Don't call Joe. Joe, this has been great. So for people, they want to find you, they want to follow you, they want to connect with you, where can they go? What should they do?
We made it pretty simple. It's USTAGI.com/the Investing in Iowa Show. That's it. www.USTAGI.com/the Investing in Iowa Show, and no spaces, just the Investing in Iowa Show.com.
We'll stick the link below / there. Yeah. Okay. The link is below in the show notes. For everybody who's listening, you can find it there to make it easy to navigate there. Joe, I sincerely appreciate you taking the time to connect here and beyond.
Hey, Nick, it was good seeing you.
Good. Sorry. You.
Haven't seen you in a while and look forward to successful 2025.
It's going to be a fun upcoming year. The optimism is extraordinarily high. So we're looking forward to it. I look forward to seeing you soon.
Thanks, Neil.
Thanks for listening. If you're enjoying the show, may I ask a favor of you? Naturally, subscribe so you never miss an episode. But would you rate and leave an honest written review on Apple Podcasts? It does a lot for us here at the show, and I appreciate reading your thoughts. Great guests make for a great show. If you know of another Iowan who would be a great guest, or you yourself have interest in being a guest, well, get on our radar. Visit Investing in Iowa to fill out an application or recommend a guest. And if you want to connect with me one-on-one, go to LegacyImpactInvestors.com. Click on the Invest With Us button in the top right corner, and there you can pick a time for the two of us to get on the calendar and connect. Until next time, keep investing in Iowa.